Well, we left off part one with talking about covered stock, and that is the purchase of stock with a put option for insurance in case the stock doesn't go in the direction that you had thought it would go in, which was up. Now, let me explain to you that it doesn't matter whether or not the stock goes up or down, but you know what? We try to avoid the hassle of it going down. We'd rather have the stock go up. Yes, the insurance is a cost, and it does cost us money to put on that insurance, but it's well worth the cost. I think you would agree. If you're buying 1,000 shares, even if you're only buying 100 shares, that one put option on your position does let you sleep at night. I mean, it gives you some comfort in knowing that if the stock does decline in price, or open up dramatically lower the very next day after you bought it, and it's happened before, it's happened to me, you won't lose a lot of money. I mean, I put a cap on the amount of money that I want to lose on initiating the position, and then at that point, either I cash in my insurance policy to buy more shares, or what I do is if the stock goes up, obviously I'm in a happy situation, and I roll those puts up as the stock increases in price so that I'm protected at higher levels. Now, I may not set it as close. I may not set that put as close. You know, if I bought the stock at $18 and I put an $18 put on there at the strike price of $18, you know, if it rolls up to $19 or $20, I might only roll that put up to the $19 level instead of the $20 level because I have a built-in profit at that point. So I'm always rolling up my puts underneath the stock price so that I have that additional protection as the stock increases in price. At some point, that stock may decline again, and I certainly want to be able to use that put as insurance to, you know, cash in to buy some additional stock at that point and continue with the trade. So that's the real benefit. Now, here's a good question. What happens if the stock doesn't do anything at all? Let's say, you know, you purchased it here at $17.50. Let's go back to our Starbucks chart again. You purchase the stock at $17.50, and it just kind of meanders, and it doesn't really do anything. And all of a sudden, you're, you know, about a month later, you're still at $17.50. Well, I don't particularly like. I'll pay 1 month of insurance on a stock, and you know what? If it doesn't pay off or the stock doesn't move, then I don't really want to hold that stock anymore. I will go into something that's a little bit more active. So I will only hold a position like this. Let's say I bought this at $18 now and I put an $18 put on as insurance. I'll hold that for a month. If I have to go back in and the stock has not moved and it's still at $18 and I have my $18 put, it's going to expire worthless. At that point, I'm going to call it a day and say, hey, you know what, the stock isn't going to move. Unless something happens in the stock beforehand, if I think it's about to make a dramatic move upward, I may stay with the stock a little bit longer, but generally I'll give it a month to move it. If it doesn't move either up or down, then I want to look for other opportunities, free up my capital, and put it into something a little bit more opportunistic, a little bit more potential. Also, there are other strategies that you could take advantage of. For example, one of the strategies in Starbucks that some people really prefer is, let's say, because June only has seven days left, we're going to go out to July here in this time frame. Let's say you wanted to buy Starbucks. You really wanted to hold it for kind of the long term. You didn't know whether or not it was going to go up immediately in price or not. Well, one of the things that you can do in order to pay for your put option, you know, let's say you buy the stock at $18.40 where it is today, and you purchase one of the 17.5 strike put options. Well, in order to help defray the cost of that put option, you can also sell a call against it. So very similar to a covered call strategy in which you buy the stock and then you sell a call at a strike price just higher than the current price of the stock. So if the stock is at $18 and you sell a call option at $19, that's called a covered call strategy. Let's just go ahead and do this. Let's do a let's see, do they have that in here? They have covered stock. They have a collar with stock. Let's go into I don't even know if they have that in here because frankly it's not a very good strategy. Someone else had asked me in the course about it. It's not a particularly attractive strategy. Let me show you why. If I go in here and I go ahead and buy the stock, let's say buy 500 shares, and then I'm going to go ahead and sell these, which would be considered a covered call here. We're going to do 5 on 5, 500 shares of stock and sell 5 of the 19 calls. Let's go ahead and analyze this. I've got some other things in here. Let me take that out first. Let's go ahead and analyze this, and I'll show you why this is not a particularly attractive strategy. What the covered call writer is hoping to do is to capture the premium of the premium here on the 19 strike price call. You'd be able to, on 5 shares, you'd be able to capture about $200 or so in premium on that if the stock does not move. If the stock moves up to $19, which is your strike price on your call, well, you're going to make a few $100s. You'll probably, if at $20, you'll make about $400, which is pretty much the cap. Well, maybe even $600 at the most. But the problem with that kind of strategy is that you have no downside protection whatsoever. You can see that the downside to the stock is basically, unlimited. If the stock continues to go down, you have an unlimited loss on the downside. That's why I do not suggest a covered call strategy. Covered call strategy is basically the same. It's the same as just a regular old call. So let's say we go into Starbucks again, and we decided to buy this call here. Let's delete that out. Let's just buy that as a call and analyze that. You can see basically that there's you have downside limited risk, and you have upside potential. But if you sold that call, you'd have basically a mirror of what you just saw with a covered call strategy. You have limited upside profit potential, but unlimited downside risk if the stock continued to go up. The exact same chart that we just saw would happen if you sold a put against that. Let's get rid of that call then. You'd have basically the identical graph, which is a limited upside potential profit and an unlimited downside risk. So, the covered call strategy. Let me just show you that again, because I wasn't able to put both of those up at the same time. We purchase the stock, and at the same time we sell the calls against it. In this case, we're doing 5 calls sold against 500 shares of stock. And you can see, there's limited upside potential and unlimited downside risk to that position, which was opposite of what we did when we sold the call. But if we sold a put, you basically get the exact same graph. I'll take these two out. That's the graph of a naked short put. And so the naked short put and a covered call strategy have the exact same profit and loss graph. In other words, when you do a covered call strategy, it is equal to selling, and we'll do the same number of shares, selling a naked put. And selling naked puts can be very dangerous, especially if you're in a down market. You can get killed. You can really get killed. You can have unlimited losses on that put. You can see there's very limited upside potential, very limited profit potential if the stock should move up, and there's unlimited losses on the downside if the stock goes down. So that's why I don't recommend covered call strategies. It's the same thing as selling a naked put, which is a very dangerous technique to use. So, what we're trying to do instead is limit our downside risk. And let me show you that graph again, because it is helpful to look at pictures. It kind of helps to determine what you're doing. Basically what you're doing is you're going in and you're buying, Well, we can do it right from here. Yeah, let's go into here. Let's see. You're buying a covered stock scenario, and we're going to do 5 shares here, 500 shares and 5 contracts. And you can see that it's just the opposite of a covered call strategy. You have unlimited upside potential and very limited downside risk. Let's uncheck this and go back to our covered stock or covered call position. You can see that you have limited upside potential and unlimited downside risk, which is just the opposite of really what we want to do. With our covered stock position, by buying the put and buying the stock at the same time, you have very limited downside risk and unlimited upside potential. That's really what we want to do. Now, there are strategies, like I mentioned. Let's go back to the trade tab for a second. There are strategies in which you could use a call strategy, writing a call strategy against your stock, but we start out with a covered stock position. So we've got our covered stock on, and then at a higher strike price, we sell some calls against that. And what that does is basically allow you to help offset the premium of your insurance. Your 17.5 calls are going to cost you 55 cents for each of the calls that you're buying, and you can use the sale of the 19 strike price calls to help offset that cost. So let's go ahead and analyze that. And what that does is basically bring up a graph like this, in which you have a limited downside risk, and you also have limited upside risk because you sold the call against your stock. Some people like this strategy. I don't particularly like this strategy and do not employ this strategy. There are strategies in which it does help to pay for your long put by selling the call against it, but against your stock, but the limited upside potential is not particularly attractive to me. Also, there are strategies though that if you do this, if the stock does not move, or it moves only up slightly, you can generate some income doing that. But I prefer not to have that. I'd rather have limited downside risk, but unlimited upside potential. Because I only want to pick stocks that are actually going to move, and move in either direction is fine with me. I prefer it if they move up, but in some cases, they don't move at all, in which case I lose a little bit of my insurance. But that's just me. I mean, you can do this covered kind of what they call a collared position. When you sell a call against your put that you're buying for insurance, it's called a collared position. Now you have to be careful though that you do not sell a call at the same strike price as your put. Because if you sell a call and you buy a put, that is a short, synthetic short position. Just like stock, you'd be synthetic short of the stock at the same time you're long the stock, and it's called a conversion. Let's see what happens to our graph if we should actually sell the 17.5 call here. You can see that we have locked in a loss of $335 here. We cannot make a profit on that position because we're short the stock and long the stock at the same time at the 17.50 price level. So you have to, if you do this collared strategy, make sure that you use a strike price that is higher than the put option that you are purchasing. So if you wanted to do something that was in the money on the put side, you'd have to go up to let's see, you'd have to go up to the 20 strike price on the call side in order to make this an effective strategy. But like I said, it's not. I don't like collaring stock only because I've lost the upside potential that I'm really looking for, and I'm only interested in purchasing stocks that have some movement potential, either to the upside or to the downside. So that is not a great strategy for me. Collared stock, covered calls are not particularly attractive. Now, some people are asking me, how do you pick the stocks that you're interested in using for this strategy? You know, if we're going to be doing this type of strategy, obviously you want to have the stock that you believe in. You want to have a stock that actually has some upside potential to it. Yes, you've got your insurance in place, and you know what to do with the insurance in case the stock goes down. You cash in your policy. You know, when stock moves down, your put will actually increase in value, and you'll be able to cash that in to generate some additional cash, not only to buy more insurance, but also to buy more shares. That's how you can leverage this. It's almost like a pyramiding effect. You pyramid your winnings in your insurance policy from your put and put it back into the stock to buy more stock. There's no more money out of your pocket in order to buy that stock. And now you've got a larger position, so if the stock does rally, you can exponentially increase your earnings, increase your profit potential on that stock, which is really a fantastic deal. So, you know, it doesn't matter if it goes up or down. Now, all we want really with this kind of a stock position is the stock to move. We want it to move down, we want it to move up, but we want it to move. We don't want it to just sit there. So that's why I said if we have a position in which, you know, like in Starbucks, if we have, you know, if we bought the stock over here and we're sitting here a month later and it's still at $17.50, and we bought it at $17.50, well, you know, maybe the potential for that stock to move has decreased somewhat, and we may want to get out of it. If you think it has potential to move, then you might want to reinvest in another month of insurance. But I wouldn't give it more than a month or 2 months at the most. If the stock hasn't moved by that time, then I'm out of that stock and I'm into another stock. Now, how do you get stock ideas? Well, a couple of different ways. One that I prefer is to use the Investors Business Daily IBD 100 stock list. I use the IBD Big Cap 20, which comes out on Tuesdays, and I also use the IBD 100, which comes out over the weekend and is updated every single week. Either one of those lists, the first, I'd say that, you know, the first 15, first 20 stocks on each one of those lists are excellent candidates to do this kind of strategy with. There are other places that you can obviously look, but the IBD 20, the Big Cap 20, and the IBD 100 are really excellent candidates because those are the strongest stocks that Investors Business Daily has identified in the marketplace at any one given time. Another rich source of ideas is Barron's, which comes out weekly, and also the Wall Street Journal. I mean, once in a while I read the Wall Street Journal, but I kind of like the list of the IBD 20, which are the big cap stocks. That gives you pretty much some of the larger stocks in the universe of stocks that have not only large volume, daily trading volume, which is important for liquidity. I don't like to get into a stock that trades less than 1 million shares a day. I prefer stocks that trade anywhere from 1.5 million on up because it does provide extra liquidity for your trades. And also, there's usually quite a few. You know, I mean, there's a lot of good options available on the exchange for the stock itself. For example, let's take Starbucks here. I mean, Starbucks has pretty liquid options. You can tell if they're liquid, not even by looking at the volume, but looking at the bid-ask spreads. So the at-the-money July options has a 2-cent spread. They're bidding 44, they're asking 46. So that's a pretty tight spread for a stock. If you take a look at something like EDU, which is a Chinese company trading, you know, the at-the-money July options have a 20-cent spread between these two. It's a little bit more volatile stock, but still, a 20-cent spread is pretty big. If you take a look at something like SWN, which I've been following, you know, it's a 10-cent spread. You know, I don't mind a 10-cent spread between the bid and the ask on the at-the-money options, but once you get to the point where they're like, you know, 15, 20, you know, 25 cents, I've seen even worse on some stocks. But the question is, I guess, let's go through the Big Cap 20 for the Investors Business Daily again. They have some of the biggest stocks that have not only the biggest stocks that have the greatest fundamentals Now I don't pay attention to fundamentals as much as I do the charts. I just want a stock that's going to move. Generally what they do is with the Investors Business Daily is rate the stocks 1 through 100 on the IBD 100 and 1 through 20 on the IBD Big Cap 20. And when you pick up a copy of the Investors Business Daily, you'll see exactly what I mean. On Tuesday they come out with the IBD 20, Big Cap 20s, and for the issue that I have in front of me, Research in Motion RIM is the top stock right now in the IBD 20. Now RIM has tremendous number of options. They're highly liquid. They do have a little bit wider bid-ask spreads, but that has something more to do with the volatility of the stock than anything. The volatility is pretty big on on RIM. You can see the July options have an average implied volatility of 58.24%. If we take a look at their chart, the RIM chart, you can see that this stock has quite a bit of volatility. It does move around quite a bit, which is something that we're looking for in a stock. However, it's also pretty expensive. It's $132. So if I was looking for a stock to invest in at the beginning, I would take a look through the list, and let's say I wanted to have a little bit of a lower risk, but a lower opportunity, but also lower risk. So I might look at something that the number 8 stock on the IBD list that I'm looking at is NXY. Nexen, and that is, generally the stock has a nice uptrend to it. It's paused a little bit up here, but if it's still on the IBD 20, it could have some upside potential to it, and that might be a good candidate. If we take a look, we want to make sure that they have some options on it, and the average daily volume on this is approximately 1.9 million shares, so that's pretty good. But the problem is here is the bid-ask spread on the 40s. Let's say we wanted to purchase the stock with a covered position. Well, we buy the stock and we buy the 40 puts. We're talking about close to a 30-cent spread on these puts. And with a 48% volatility, it's a little bit more expensive. But let's say we wanted to buy 100 shares. Let's go ahead and analyze that. You've got a maximum risk of $226 on that. So it's not too bad, of course, with the unlimited upside potential, which is nice. However, you can do it a different way. Let's say you find a stock. Let me get back to my trade tab here for a second. Let's say you find a stock in the IBD 100, and in some cases they don't have options, or the bid-ask spread on the options is too large for your comfort. In other words, you're paying a 30-cent spread here. You're going to hold. It's not too much of a problem if you're going to hold the trade for quite a while. If you're going to hold it until at least July expiration, which is fine. But in some cases, you might find a stock that is, traded that either doesn't have options on it, or it has too large of a bid-ask spread. Well, what do? Are you locked out of those kind of trades? Well, not necessarily. So we're taking a look at Investors Business Daily, and I've gone through the IBD 100, I've gone through the IBD 20, and I haven't really found anything. Investors Business Daily also has a couple of sections in the newspaper which also can give you some ideas for stocks that you might like to purchase. And that is the NYS in the news, stocks in the news, and the NASDAQ stocks in the news. And I kind of look at both of those as well, because they kind of highlight stocks that are up and coming. There's plenty of ideas in the Investors Business Daily. You don't have to necessarily use the IBD 100 or the IBD 20. The NASDAQ stocks in the news has a couple of really interesting charts for some stocks there that may do very well. So I pull up one of the stocks that I'm interested in, and it's Almost Family Inc., which is AFAM. But as you can tell, there are no options for this stock. So are we stuck? That's the question. Let's say you wanted to buy some shares of AFAM. You really think this stock has absolutely wonderful potential over the long term. It's coming up against a resistance point here, which tried to bump up against a couple of times. You feel it's going to break out to the upside, and you really like to buy some of these shares. Now, I wouldn't recommend it because the average daily volume on this stock is pretty low. It's less than looks like about less than 20,000 shares of about 20,000 shares or less, maybe 60,000 shares a day. So that may eliminate this kind of a stock. What you're really looking for is maybe a stock like another one that is looks like it has a little bit better daily volume, called Psychiatric Solutions, PSYS. Now, it doesn't meet my criteria of 1 million shares a day, but it has had a couple of days at which it got over 1 million shares. If we take a very close, a little bit closer look at this, it's only trading 147,000 shares today. It's been up around anywhere between 700,000 and 500,000 shares. A couple of days where it hit 1 million, so it's starting to grow in popularity, and you really want to get in kind of early on this. The problem, of course, is that the options are probably extremely thinly traded. Let's take a quick look at that. Yeah, they're pretty thin. I mean, there's only 3 strike prices and they're $5 apart. You got 20 cent bid-ask spreads. If I took a look at the volume in open interest, they got 39 on the July options. There's only 39. That's the total open interest for these options. The puts only have 15 open. Open interest is only 15 contracts. That's pretty thin, So even though you like the stock, the number of shares being traded every single day isn't huge, but you feel that it has some potential. I've drawn a little flag pattern here, so it looks like it's a continuation pattern that may actually move the stock up a little bit higher. And you really want to get into this stock. What do? How do you protect yourself? Well, what you can do is you can go ahead and click on the buy. Let's say you only wanted to buy 100 shares just to open, just to get your feet wet in this stock and begin to have some sort of potential for the stock itself to determine whether or not it's going to move. How do you protect yourself in this stock? Okay, so let's say we've got 100 shares. Let's just say, for example, that we want to buy 100 shares. Now, the options are not particularly attractive because they're really not very active here. The open interest, like I said, is only 15 on these 35 put contracts, and there's only 2 contracts outstanding open interest on these July 40s. And also they're pretty expensive, and the bid-ask spread is pretty wide. So what would we do here? Well, let's take this over to our Analyze tab, and oops, I lost that. Let me go back in here. Let's go over to our Analyze tab here. Now, here we are with 100 shares of our stock at $36.81. How do we protect our downside if the options are not particularly attractive on the stock, but we do want to own the stock? Well, what we're going to do is we're going to take a look at our delta, and our delta is actually 100, because on a stock, a delta will move stock will move point for point up or down with price changes in the stock. So our delta is always 100 on stocks. Now, what we can do is go up here, and what we're going to do is we're going to switch from a single symbol to a portfolio beta weighted. Remember this from our previous lessons of trying to determine the true delta of our portfolio based on the beta weighted positions of our portfolio. Well, we're going to do the same thing for this type of a trade. What we'd like to do is say, hey, I've got 100 shares of this stock, and I'd like to be able to protect it from any downside risk. In order to do that, I need to get delta neutral, or as close to delta neutral as I possibly can. In order to do that, then, what I'd like to do is pick an index in which we could use in order to hedge this stock position. When we pick an index, we obviously want the most liquid index that we possibly can find. Preferably, we would like to have an index that has penny-wide spreads and also maybe $1 strikes between them. So that's why I like the Qs. The Qs have $1 between the strikes, so that they're not really large. The strike prices are not particularly wide. And also, in most cases, you can get a penny between spreads, maybe sometimes 2 cents. For some reason, this has a 3-cent spread today. well, we're looking at the June 5th. So I want to look at the July spreads. Here we go. July options. There's a there's a 1 to 2 cent spread here. There's a 1 to 2 cent spread here. There's a 1 to 2 cent 1 cent spread in between these. So they're extremely liquid options. The open interest, you can see, is huge. I mean, look at these 48s here. They have 200,000 contracts open. So, if we wanted to hedge our position, if we wanted to provide, get to our position so it's delta neutral, what we would do is look at the Qs. Now, you could also look at some other indexes. I mean, you could actually beta weight your stock position here that you're buying against any of the indexes. Let's say, for example, the S&P 500 ETF or the SPY. You could do the exact same thing. I don't like to use the SPY to hedge my portfolio because they do have a little bit wider bid-ask spreads. They have 10 cents on these here. This is 5 cents over here. Make sure I'm looking at the July contracts. Yep, I am. Or you could use something like the Diamonds, which is the Dow ETF. You could use that as well, but again, you've got, they're a little bit better bid-ask spreads, about 4 cents. But why use those when the Qs, not only do they have the dollar-wide strike prices, but they also have very, very tiny bid-ask spreads in those. So what I would do is I'd go back to my Analyze tab, and let's say we've analyzed our stock. We're buying 100 shares of PSYS. We've got a portfolio weighted position. Now what we want to do is we want to try to get our deltas to a neutral position to help protect our stock. Just like we did, we wanted to buy, we've got unlimited upside potential, but we also have, a limited downside potential, but the potential could go down to 0 if the stock goes down to 0, right? So we don't like that kind of position. So we're going to put in the Qs here to beta weight our portfolio. We're going to go back to our trade tab, and we're going to select a 48 put, which is just about at the money. We're going to bring that over to analyze a QQQ 48 July put, and we're going to put it into our mix and see what we come up with. Well, if we purchased one share of the Qs, or one contract of the Qs at the July 48 puts for $1.36, on a portfolio weighted basis, taking into consideration the stock that we have, it reduces our delta down to 32, or almost 33. That's not bad. Let's see if we take that out. You can see that based on the Qs, because we're beta weighting our stock position against the Qs here, we have a delta of 77. So if we purchased one put of one of the 48 puts, it gives us a negative delta of 44.96 against our 77 beta weighted position. And now we have a delta of 32. If we purchase two of these, it almost brings us to a delta neutral position, but it actually makes us a little bit short delta. What you decide to pick depends on your comfort level. Our maximum risk, if we were to purchase two of the Q48 puts, puts us into a position where if the stock doesn't move at all, we're going to lose about $267, which is acceptable in these kinds of positions. If we selected one to hedge against our 100 shares of the PSYS stock, then you know what? We have $149 of maximum risk in this position. And you know what? It does hedge us very, very nicely in any kind of downside action. In fact, if the stock drops dramatically, we can actually make some money on this stock. So our maximum risk is right around $145 if the stock does not move at all. And it also does not limit our upside potential. If the stock continues to move up, we have unlimited profits to the upside. So you don't necessarily have to buy an option on the stock that you're actually buying. Like I said, this PSYS stock looks kind of attractive with this little flag pattern going on here. Eventually this stock will probably continue its uptrend, but the problem is, of course, is PSYS has very illiquid options. I just don't like these options because there's very few outstanding contracts here, and getting out in and out of these if we have to could be a bit of a problem, and it's going to cost us a lot more money. Using the Qs to hedge this position and give us a limited downside risk with in keeping intact our unlimited upside potential is a better choice. Now let's say you've got we just selected one stock here, but we could actually probably go through a couple different ones. Even if like I said, even if the stock has option contracts on it, it doesn't mean that we have to use the option contracts on that particular stock. We only use those particular options on those particular stocks if they're highly liquid and they have nice, very, very small bid-ask spreads like it did on Starbucks. So let's go over to another, let's say another stock that we're interested in buying. Let's say we're interested in buying this Woodward Governor. It's a stock again that has a fairly low daily volume, but it looks like it has a lot of potential. I'm just using this as a hypothetical example, of course, and I'm not recommending this stock. Let's go ahead and purchase maybe another 100 shares of that. I'm just going to get rid of that just for a second. And let's say we wanted to buy something else as well. We're looking through our NASDAQ stocks in the news, and we see Fluor Systems. And that looks like kind of an interesting stock. So we're going to buy 100 shares of that. And if we go over here and take a look at our charts, FLIR, yeah, it looks like an interesting stock. It's been going up. It could be a very, very good trade. WGov, let's take a look at that real quick. Yeah, that's been going up. That looks like it has potential. So now you've got maybe three stocks here that you want to purchase 100 shares of each. And how do you protect all of these? Well, you can go back in. Let's analyze that as a duplicate trade. Let's take the Fluor stock and analyze that as a duplicate trade. Now you've got three of these, and what you've done is we want to beta weight this against the Qs here. Our downside protection doesn't look very good because we only had one contract on the Qs, but now we've got 300 shares of stock in three different stocks. How do we protect these? How do we do a covered stock position on these? Well, all we have to do is increase the number of puts that we're purchasing. Remember, when we did our Starbucks stock, if we started out with 1,000 shares, we had to buy 10 contracts on the puts in order to equal the same number of shares that we had on our stock. Because each contract, remember, is equal to 100 shares. So if we've got 300 shares of stock, then it makes sense that if we increase the number of puts that we purchased, it will give us a simulated protection, just like we did on our covered stock position. The only difference is we're using the QQQs as a hedge against our stock position. And this is the way the hedge funds, the large investment managers do it. We have an advantage, actually, as individual investors to create more flexible positions because generally our positions are going to be a lot smaller than the hedge funds. Hedge funds have to come in with millions of dollars of stock options and purchases, and they have to negotiate with banks and other investment companies in order to put on their trades. On the other hand, we can go in, we can buy 100 shares of this, 1,000 shares of that, 100 shares of this, 500 shares of that, and then hedge them with index options like the Qs in order to hedge our entire portfolio. Now what's happened to our position? Well, now we have a maximum downside risk of about $400 by buying the Q put options for July against these 300 shares of our stock. It gives us a good deal of downside protection as well as unlimited upside protection, which is what we're looking for. So, our delta is 157, so it's a little bit strong. It's a little bit, it's a good delta if the stock does move up. If all of our stocks continue to move down, then we don't have quite as much protection. On 300 shares, we may have to adjust this up a little bit, just maybe buy 4 contracts for our 300 shares in order to get to a position where you feel comfortable. So in other words, our maximum loss here is going to be about $583 if the stocks we pick do not move, or the QQQs do not move. And if our stocks go up, yes, we do have unlimited upside potential. And actually, if we get hit with a really bad bear market and all of a sudden our stocks go down, well, our Q position is actually going to make money for us and act as a hedge against our long positions in our stocks. This is the way, like I said, hedge fund managers and professional investors manage their stock positions. They don't, just like we did with our option positions in our monthly income trades, we look at the numbers. We trade by the numbers. We take a look at our delta. We take a look at our, we take a look at primarily our delta position, but we also take a look at our profit and loss over time. We are hedging our stock positions based on portfolio-weighted QQQs, and then purchase the number of Q puts to help protect the downside of our stock position. Let's say if we take that out, you can tell that if we take those Qs out and we did not buy those puts as protection, yes, we still have unlimited upside risk, but we also have almost unlimited downside risk. I say almost unlimited downside risk because the stock can't go below zero. But if it does, in fact, if our stocks do go to zero, we'll have lost a maximum of our investment, which is about $13,800 in these 300 shares of these three different stocks. So hedging, as you can tell, is a very, very good investment. It does limit your, it does put a little bit of a limit on your upside potential profit. However, that is a price well worth paying as insurance, because you also have a very nice downside protection. The only thing that you have to be concerned about at this point is that your stock's not moving at all. Now, what can you do? Well, you know what? You can do the same thing. If your stocks go down, you can do the same thing that you were going to do on each individual one of these positions. Let's say the market just fell apart and all of a sudden dropped a few thousand points. The QQQs went down to extreme levels, and we lost about 10 or 15 points on the Qs. Well, you take those profits and you would reinvest it maybe in another 50 shares or 50 shares of that or 50 shares of that. You can divide it any way that you want, but use that insurance policy that you cash in if the market goes down in order to purchase more stock, so that when it does go up, you'll be in a really nice position and you've added shares to your position that were basically free. I mean, basically because you purchased that put option to begin with, you have no more you don't have to take any more money out of your pocket in order to buy additional shares of the stock. So that's how hedge fund managers do it, and it's really a smarter way to manage a portfolio of stocks by beta weighting them, using the analysis tab, beta weighting your stocks against an index like the Qs, and then determining the number of puts that you want to buy on the Qs in order to hedge your position. Now, you can. I picked the 48s as the strike price, which is just about at the money here. But you could also go deeper in the money if you wanted a little bit more protection. Of course, it is going to cost you a little bit more. So if you wanted a little bit more protection, you could go up to the 50s. It'd give you a little bit more protection, or you could use the 49s. It's really up to you how much protection you actually want. If you want to get totally delta neutral, all you have to do is play around with the strike prices. You get down to 15 or 20 deltas, you're pretty close to delta neutral here. My suggestion is to be a little bit long delta, maybe 15 to 20 or 50, rather than short delta, because you want the stocks to move up. That's why you bought them in the first place. So you can play around with the strike prices and the number of contracts any way that you want in order to determine the amount of risk you have. The longer the delta, the more risk you'll have on the downside. The less delta you have, the less risk you'll have on the downside. But that is totally up to you. Whatever is acceptable to you. So that's how I manage a portfolio of stocks using the indexes, and I think it's a smarter way to trade. And also, it's a this is the way to build real wealth, especially if we're in a bull market in stocks. At this time, it's questionable whether or not we're going to have a bull market in stocks, because the market has actually gone down quite a bit. If we take a look at the quick chart, I mean, I don't want to time this as a, but you know, we've come down pretty heavily here over the last 6, 7, 8 months, and you know, it's questionable whether or not we're in a bull market. So this type of a strategy can be used at any time. It can be used when the market is up to protect yourself from a downside draft that could wipe out, you know, a lot of the profit that you might have in stock that you already have. And if you already have a portfolio of stocks and you're not hedging those stocks with put options, or if you're not hedging a portfolio of stocks that you might have, I think that's a mistake, because you could wipe out a good deal of your not only profits that you may have on that, but also you're losing an opportunity to, you know, purchase insurance on your portfolio and then cashing that in later if we do have a big downdraft in the market, losing you know, a lot of the Dow gains, or the S&P 500, or the NASDAQ. So this is a very smart way to trade. This is something that you can do on an existing portfolio of stocks, not just the stocks that you have. All you have to do is take your portfolio, bring them over to the Analyze tab, and beta weight this against any index, whether it's the S&P 500. Let's take the S&P 500 for a second. We're going to beta weight this against the S&P 500. I'm going to take these Qs out. I'm going to go over to the Trade tab, bring up the SPYs, and let's say we buy the at the money 130, which would be about the 135, 136. Let's go with the 136 puts here. Let's bring that over to our Analyze tab, and I'm just going to close these up a little bit. And we still got our stock position. Now, what happens when we buy one of these? Well, it brings our delta from 148 down to 98. We may have to buy 2 of those before we feel comfortable. We can also play around with the strike price. We can bring it down to 135. We can bring it up to 136. But by playing with the individual positions and taking a look at, you know, your delta, you want to be, like I said, you probably want to be a little bit long delta to capture some of the potential profits in the stock as it moves up. You should be doing this. You should be doing the purchase of your stocks anyway if you are slightly bullish. It's always better to be slightly bullish if you're buying stocks. And if you're not bullish, then maybe you should stay out of the market until you feel like you're bullish. But if you want to bring in your stocks and you want to portfolio weight them, you can weight them against the SPY like we did here. You know, we want to buy maybe 2 would be a nice little hedge against any downside risk in your portfolio. But you could also, you know, you could do it against anything. You could do it against the SPY, ETFs. You could do it against the Qs like we did before. You could do it against the diamonds. You know, if you have a number of stocks that are a portfolio already comprised of Dow Industrial stocks, you might want to use the diamonds as a hedge. You know, use the diamonds in order to hedge your position. Really, the options here are quite unlimited. So that's how you hedge your positions. That's how you make money in the stocks. It's a terrific way to limit your downside. It's an absolutely dynamic way to trade. It gives you unlimited upside potential on any stock that you might own, and it limits your downside risk to those stocks. And in fact, the way I've told you to trade is to use that insurance policy by buying those puts, and when the stock goes down, cash in that insurance policy to buy more insurance at a lower price, but also to use the excess cash that you've generated in order to buy additional shares of stock. You know, eventually, you know, I gave you an example of one particular trade that had initial investment of $14,000. Well, what happened was that the stock continued to go down and then it went up, and then it went, it went down again, and then it went up again, and eventually a 1,000 share position turned into a 4,000 share position because of all the insurance that I was able to cash in by cashing in the puts. And then eventually there was a large rally in the stock, and it turned into a $75,000 position from a $14,000 position with absolutely no additional investment necessary. And that was in NVIDIA. There was a tremendous amount of, it was just, NVIDIA's just been it was a terrific ride. It was up, it was down, you cash in your puts, let's say you purchased, this is pretty interesting, let's say you purchased, 1,000 shares at $20 here. And over the period of, this is a weekly chart, but, if you go back to some of these periods here, you had some pretty dramatic price movement here. And you could have cashed in those puts that you had to buy additional protection and then buy more puts. Well, when you cashed in those puts, you bought more shares at the same time. So starting out with 1,000 shares, you could have cashed in some puts here. You could have bought another couple hundred shares, bought some more puts, cashed in here, bought another few hundred shares, bought some more puts, cashed in here, bought some more puts. Cashed in your puts from the previous purchase and bought some more shares. But eventually, by the time you get down to this point, instead of 1,000 shares, now you've got maybe 3,000 shares, and you've got this huge run up here, in which you just make just an absolute ton of money. So that's how you really build wealth, and you build it very, very quickly in the markets by doing exactly this type of trading. All right, guys, that's it for this part. Trade with confidence.